Okay. So again, thank you for joining us at AMS's financial training, our first virtual class of 2020, on the accounting side, that is. Many of you probably, hopefully are involved with the financials. Some of you may not have as much information or knowledge, but I'll try to hit some points that help everybody with their understanding. So what is accrual accounting? TMG and AMS, we produce all of our financials in accrual accounting. It's a method that measures the performance of your entity by recognizing your economic events, whether it's regardless of when the transaction occurs, when cash trades places. So if you charge in your assessments, but people don't pay, it's still recognized as revenue. If you have an expense, say a vendor comes out and does a project on your property, but you haven't paid them yet, that expense is still recognized when they finish that job. So that confuses a lot of people because it is not cash accounting. The core concept is that when revenue and expenses are recorded and recognized when the services are rendered, so revenue is rendered or expenses are performed. This provides a more accurate picture of your association and their financial condition than any alternative methods such as cash basis. We produce our financials under GAAP, which is generally accepted accounting principles. The reason we do this is because your CPAs also have to record your financials in accrual. And in essence, this does save your association money in the long run because the CPAs do not have to redo your financials in accrual. We provide financial recap with your reports. Now, the financial recap is where we take your accrual accounting and we put it into a cash basis. So we kind of essentially give you your little checkbook of your cash position, but that way we don't have to modify your financials. We just give you that separate report. We also do what they call fund accounting. This is the method of segregating your resources into different categories or funds. Right now, many of you have been with us a long time, and we do, in our new software, we can do cost centers. That is what we are referring to as categories, which in our terms are cost centers. Your funds are separated and not commingled. The most common types of your funds for your association are your operating fund and your reserve or replacement fund. The operating fund is used for your day-to-day operations of your association. It's not there for your large expenses. The reserve fund is what you use to cover your major repairs and capital replacements. Generally, that will follow your association's reserve study and or maintenance plan. If you don't have that, we recommend that you do have a reserve study and maintenance plan. Special assessments and community rehab funds are also separated into their own fund. They're generally used for a larger project, such as a construction defect, deferred maintenance, projects that are outside of the normal of your association, unforeseen expenses, and generally they're very large. Also, special assessments can be for operating shortfalls. That is more rare than anything. When we provide you your financial package, you get a normal monthly financial packet, which includes a financial recap, your balance sheet, an operating budget and comparison report, a reserve budget and comparison report, an AR aging, a prepaid assessment report, an AP aging, which is accounts payable, AR is accounts receivable, in case you didn't know that, general ledger, and a check register, which will be followed by images of your paid invoices. Now, these are the general financials that you'll get. Now, if you have a special assessment or additional cost centers, those will be also included, and that's what they call a operating budget a reserve budget comparison or a special assessment budget comparison. Those are your separate reports. Special assessment financials. What makes them different from your regular financials is that these are, again, segregated funds, and we have to keep them segregated because you're generally following your special assessment resolution, and we have to keep those all separated and keep a detailed ledger of those. So types of special assessments, again, would be a construction rehab, capital projects, operating shortfalls. We'll take a look at those later in the presentation. Sorry, my computer's a little bit slow. So the monthly financial recap report, this is the one that I talked to you guys about in the beginning. This is where we take your accrual accounting and convert your financials into a cash basis. This will give you a clearer understanding of your association's financial position. This is used only as a guide to assist you in cash management of your association. On your financial recap, we have at the top your association and the date and the time. That's the time period that this is for. So this one says it's for June 30th, 2020. So that would be for just that month. We have all your starting fund totals, or actually that'd be your ending fund totals, in that account balance overview section. And we have net cash flow, which is where we actually take and break out liabilities from your cash to give you a better position when we talked about turning it into a checkbook for you. I'll go into detail on that a little bit in a further slide. On your balance sheet, this is where all of your assets and liabilities of the association are listed. This is a snapshot of your association's financial condition as of the specific date. Again, on this particular financial, it's as of 6/30/2020. The way that accounting people look at it is assets equal liabilities plus your equity or capital. Notice that our balance sheet has 3 sections. So we have assets, liabilities and equity, and your long-term liabilities. Assets include cash, prepaid insurance, due tos and froms from your funds, and assessments receivables. Your liabilities are any obligation that the association has that's arising from past events or transactions which may result in the transfer or use of assets in order to satisfy them. So for example, prepaid assessments are monies paid by owners for future assessments of an association. The association is obligated to return those funds back to the owners or past owners. This is why we back these amounts out of your available cash on the financial recap, because we don't want you spending those funds just in case those people should move out. This is where we back it out. So if you look at your financial recap under operating fund overview, we have taken your cash balance at the end of the month, and we've backed out your payables because that's money we still owe. Your prepaid assessments, again, money you may owe should an owner move out, and any other accrued liabilities that we know that you're going to have in the future. And that, again, points to your balance sheet. So there's your accounts payable of 4703, prepaid assessments of 12,922.81, and other accrued liabilities of 6726.22. Those are monies that we back out of your available cash because they are future possible expenses to the association. Your balance sheet has, in most cases, you'll have just the 2 columns, the blue and the green column. Some associations that have special assessments will have that 3rd column. And we actually have some other associations that have 4, 5, and 6 columns. It just depends on what your association has going on and how much we have to segregate funds. But in this particular case, they have a 3-sided balance sheet: operating, reserves, and special assessment. So your operating fund, these are your operating funds to be used for operating expenses for the association that follows your current annual budget for the operating account. The green section, number 2, your replacement fund. These are your segregated reserve funds that are to be used only for your reserve expenses per your reserve study and or your maintenance plan for your association. And the yellow, number 3, kind of yellow gold column, that is your special assessment and community rehab segregated funds. These are segregated special assessment or construction rehab funds that are to be used only for rehab project expenses per your special assessment or community rehab resolution for your association. On your balance sheet, again, we mentioned there's the different sections. So in your assets, you have your bank account and investment balances. That includes your reserve accounts, CDs, any investments that your association has going on. If you'll notice, when we transition to our new software, we now list your different accounts out with the current interest rate that they're earning. And if you have CDs, we'll actually have the maturity date listed there for you as well. We also list your assessments receivable. These are people who have not yet paid you. So this particular example, this association has $441 in assessments that are still owed to them from previous months. Prepaid insurance. This is the balance of the insurance that we've paid on your behalf for the current policy period. So we've expensed off the months that we've passed through, but these funds are used to pay the expenses for the upcoming months. What I mean by that is you've already paid it, but again, because it's accrual, we can't recognize those expenses until the event happens, and those events actually have not happened yet because you've paid for them you've prepaid for them for future. So we put them on your balance sheet as a prepaid insurance that will eventually get expensed out to your budget comparison. Any other prepaids are listed on there as well. This could be anything from if you have, let's say, a tower that has an elevator and you have a annual elevator contract, we will also do the same thing. We take it, divide it by 12, figure out how much each month's expense will be. The prepaid goes on your balance sheet, and then we monthly expense it for you. This also helps you keep your budget intact, and when we look at your budget comparison in a couple slides, it helps you just keep all that in order so that you know where you're sitting on your budget each month. Your accounts payable, those are generally we don't have too much in this column, but it is happens sometimes right at the end of the month. We'll get invoices in for expenses that happened right at the end of the month, but we have not been able to pay yet because it just, let's say we got the expenses on Wednesday and your financials were produced on, or the month end was Friday and we haven't cut checks yet. You'll have accounts payable on your financials for that. Your prepaid assessments, we talked about this a little while ago. This number represents the amount of money that's been paid into your association by your owners for upcoming months. So that has not been recognized yet. The association would have to refund should that owner sell their unit and move out tomorrow. So it's a liability until we move into the next month, and 1/12 of their assessment then gets applied to their account, and 1/12 of their payment gets applied to their account. Other accrued liabilities would be anything else that the association owes that has not been recognized yet. So this would be, trying to think of what other accrued liability would be. Do you have an example, Morgan?
Like if you didn't get the water bill?
If you did not get, okay, so we're also looking at your expenses for water, sewer, electricity, all of those expenses that should hit your month, landscaping, any of those bills that we did not get, we know they should be coming in and we're expecting them, we will accrue them, and that would hit that GL called other accrued liabilities. You'll also see sometimes it's called other accrued payables, depending on the association. This particular association does have a special assessment. So you'll notice the next thing is called long-term liabilities, and they have a loan payable. That is, this particular association has a loan for construction rehab or special assessment that they have taken on with the association. So we book that loan payable, again, segregated under the special assessment cost center. And each month that number will change as we make your loan payments and or your owners pay off a special assessment and we do a principal pay down. That number will change based on the activity of that loan. And then the last thing on there is called net income. That is your current year's net income or loss. So if it's positive, if you've had an income, it's a positive number like you see there. If it is a loss, it would look like the retained earnings line where there's parentheses around them. That is a loss on a balance sheet. So this particular association in prior years have had a loss of $2,000, but so far this year they actually have a positive, they're positive to the cash of $12,000. So a net of only $10,000 between all the years. So on this year in 2020, there's been a new change. We sent out a notice to all the boards that there's a new revenue ruling that took place in GAAP, and we have to abide by it. It is where, I'm going to move to the next slide. This is where you see it on your balance sheet. The difference is we don't have a net income or retained earnings in the reserve column, and I'll explain why that is here in a second. The newly adopted revenue ruling, which is called the ASC 606, this is put out by the Financial Accounting Standards Board, and your CPAs will refer to it as FASB, F-A-S-B. This is newly adopted it was adopted in 2019, and everybody had to take effect as of, I think it was December of 2019. So all the financials that are being done for year end have this new revenue ruling. It is for homeowners associations. The purpose of this change is to recognize reserve revenue as it is used. Reserve funds are funding capital expenses that can be many years out. With this new ruling, the only reserve revenue that will be recorded in the current year will be the reimbursement of any expenses your reserve has. So let's say all you did for the whole year is put new bark dust in your association. We would have to recognize that amount of revenue for your association for that calendar year, less any interest your association earns on your reserve funds. So this new revenue ruling has very little effect, little to no change on your operating funds. The biggest area of change is on your reserve funds. And the community rehab special assessment funds, this one will vary based on the way your special assessment was set up and how it is being used on an annual basis. So your CPA who does your audit or review will determine the best way to record that at your year-end activity for your audit or review. AMS did implement this for the year 2020, but the CPAs are making these adjustments for your 2019 financials. Next slide. So probably one of the most important financials for especially treasurer to take a look at on a regular basis is the budget comparison report by cost center for your operating account. This follows your budget, annual approved budget for your association. So I really recommend that you understand this and try to, if you have questions, we will address those. So a budget comparison report has 7 very important columns. You'll notice these are color coded. So your first column, this turquoise column, is called the month-to-date actual, which also ties into your year-to-date actual. This is your income and expenses for the current reporting period, and then the year-to-date is your year-to-date balances for the beginning of the year, your calendar year or fiscal year to the current period. It's for all your income and receipt and expenses that have been received from either in that current period for month to date or in the current year to date period. This then ties into the yellow or gold column, which is your month to date budget, year to date budget. These are the areas that your treasurer should be taking a look at and keeping a close eye on, because we are comparing what you actually budgeted in the gold column to what you actually did in the turquoise column, both at month-to-date totals and your year-to-date totals. The blue column on both of these, year-to-date and month-to-date, these are the variances of those columns. So for instance, on the assessment income, you budgeted for $34,062.50. You actually collected $34,100. So month-to-date year variance is only $37.50 above your budget. And for year-to-date, you've actually collected $225 more than your budget. Now, I'm sorry, less than your budget. I did the wrong way. What that means, a lot of associations budget to the penny, and these will always match to the penny. But several of them actually round. They'll just take all the expenses divided by the units, divided by the 12 months in a year, and plunk that number in there. And that doesn't necessarily match what they then decided to round their assessments to. So that number might have come to $310.56, but they decided to round it up to flat $311. That's why there would be a variance here, is because the association decided to round the assessment up instead of going with the actual number that the budget came out with. So again, matching your income and your expenses is very, very important for you to watch and ask questions about. So for instance, in this one, you'll notice that, again, the assessments are off slightly, but again, that's due to rounding. Understanding that when you're doing your budget and then while you're watching your financials will help you understand why there's a variance. When you look at the expenses, for instance, your landscape maintenance contract, you'll notice here that the budgeted amount is $5631.42, but the monthly expense is only $48.78. You're under budget that month by $753.42. Year to date, you're under budget by $5611.41. These types of things are things that the CPA is going to point out when they're doing your audit or review and ask questions as to why. And you know, it could be that you expected certain expenses that, or you expected a certain contract and then you changed your vendor and got a better contract. It could be that we need to look at those expenses and see if something didn't get expensed correctly and get those fixed before year end. It could be that when you guys budgeted your landscape maintenance contract, you added in some variables that your manager may already be aware of. Say, for instance, you budgeted in the annual planting of your flowers out front to make your association pretty. Those are things that your manager is aware of, and your treasurer should be aware of when looking at your budgets and seeing why you're under over budget in certain areas. On your budget comparison, the one area that we can tie into your balance sheet is the net income or net loss. Again, we talked about this early on. A net income is going to be a positive number, as you see here in this slide where the red arrow is. A net loss would have a parentheses around them. That would mean you lost money. But in this particular association, they've so far this year, from January to this to June, they have made $12,200 or $12,002. Now, HOAs, as many of you know, are a quasi nonprofit, and we do zero-based budgets because you are not supposed to earn an income. I mean, you budget for no income because all of the money comes in, should be paying all your expenses. So chances are this particular association has some expenses that are going to hit later, especially during the summer, probably water, irrigation, some of those expenses that go up in the summer, because a budget is taken, we take it and divide it by 12 equally, but certain months expenses go up, and that can fluctuate your budget. You really start seeing it all come together in November, December, because we're getting, for those of you with a calendar year in, we start seeing those come together at the end. And again, this is how it ties out. So this is off that budget comparison we were just looking at, $12,002.61. This is from the balance sheet, net income of $12,002.61. So if you look at your budget comparison, net income year to date, and your balance sheet net income, those two will tie together and should always tie together. One of the things that associations struggle with a lot is, how do we handle bad debt? It's a guesstimate for any association. Bad debt is one of those things that you're having to kind of guess at. It's typically an association will take a look at their current year while they're doing their budget, and they'll determine if there are units that they anticipate will not pay, or they may possibly write off that balance in the coming year. Say they know somebody's going into bankruptcy or did go into bankruptcy, or there's a home that's in foreclosure and you just know you're not going to collect those funds. It's important for the board to consider these because these units will not be paying assessments, and that affects all your other associations in all the other owners in your association. So bad debt is one of those things that we really recommend that you consider when you're doing your budget. Now, writing off a bad debt does not mean that it goes away forever. If your association is using a collection company and they're able to recover that money, we can recover it also on your financials. Under revenue, we recover it under bad debt recovery. So it's not gone forever, but it cleans up your financials. It puts you in a better position as far as the way everything looks, and it's a more accurate picture of your association, because truly, most bad debt is not recovered, but on occasion we can get it. We just had one not long ago. We were able to recover thousands of dollars on bad debt. When I say we, your association's collection attorney was able to collect it. So we recovered it as recoverable bad debt. So it's not gone forever. It's something you should consider, and it definitely affects your financials, especially for your homeowners. So if you want further information on this, we're happy to help you with that. Catch up with me. Now, when you do bad debt, what we do is we actually set up what we call an allowance for doubtful accounts on your balance sheet. So some of you already have this. You'll notice it on your balance sheet. You'll see your assessment receivable, and right below it, you'll see this allowance for doubtful accounts. What this is again, that guesstimate of how many owners you think are not going to pay and or you're going to end up writing off at some point. Doesn't mean it's going to happen tomorrow or next month or next year, but you're telling anybody looking at your financials that we anticipate this much of our current receivables or past due receivables is what we deem as uncollectible. So in this particular association, they have almost $4,000 in their 90 plus day column. Of that, so far they've written off 2,500 of it as what they deem as uncollectible. And again, that ties into their budget comparison. So these two numbers tie in together, which correlates to what they've decided is their bad debt. Now, if you were to look at this, if we looked at the detail, and let's say you had two owners that were your $4,000 in over 90 days, let's say there was 3,000 of that is truly going to be bad debt. This particular association would want to budget another $500 in bad debt to accommodate what they think is going to be written off or deemed uncollectible. So the one financial or budget comparison we didn't look at was the reserve budget comparison. We again cannot commingle your funds. So we provide you, most of the reports are on your operating account, but we do provide you your segregated financial budget comparison for your reserve account. So this one is clearly the funds that are affecting your reserve balance at the bank. Any monies that came in, any transfers we made into your reserve account, and any expenses that you had, plus any little bit of interest that you've earned. Right now, banks aren't paying much interest, so some of these numbers are pretty low. But any investments, if it's specifically reserve funds, all those funds, income and expense, will be on your reserve budget comparison. The next two slides are to dealing with your AR and your prepaid. Again, AR means accounts receivable. So in this particular association, we've whited out the names and account numbers to protect the names of these people. However, as you can see in this particular one, we have 3 owners who are on the receivable at the end of the month. They are current because they have not fallen past 30 days yet. But these are the 3 of all their owners that did not pay as of the end of the month. And that ties to your balance sheet, which I'll show you in a minute. These are the prepaids. So they had almost $13,000 in prepaids, and these are all the units and the amounts that they prepaid. So if you recall at the beginning of the training, we talked about that this is a liability to the association. Should any of these owners move out tomorrow, the association has to pay them some of these funds back. This particular association has dues around $310 a month. So these 310s are all people who paid basically 1 month in advance. So this will be gone next month. But you'll notice that we have a lot of people with balances over $1,000 and almost $2,000. Should that owner move out tomorrow and we've moved into the next month, you may have to refund about $1,500 of this to them. So that's why we don't recognize this as revenue on when we do your cash adjustment of your cash balance, because we don't want the association spending this money in case any of these owners move out and you should have to refund the money to them. So again, here's where we have your assessment receivables of 441 matches your balance sheet. Purple matches purple. And turquoise, which is your prepaid assessments, 12,922.81, matches the prepaid assessment report of 12,922.81. Again, those should always match every month. The other thing you'll see on your balance sheet is your accounts payable. On this particular association, it's GL 2000 accounts payable of $4,700 at the end of the month. That $4,700 is listed on your accounts payable aging report, and it breaks it all down for you what those numbers are for. So right at the end of the month, it appears that they got invoices in for their insurance and a Comcast bill and something else, some repairs. Those are now will be paid the next month. But again, we recognize the expenses because it's happened. So the payable sits on your balance sheet until we pay the bill. You're also provided a general ledger in your financial reports. This is the first page and the last page. There's anywhere from, some associations might have 10 pages of general ledger, some might have 50 pages of general ledger. It just depends on how large your association is and how much activity your association has. So the nice thing about a general ledger is it gives you all the detail that is hitting all those different places in your financials. If you notice when we were looking at the balance sheet, the budget comparison, those have GL numbers. I'm going to go back to the balance sheet here so you can see this. All of these have these numbers before them, like Alliance Bank operating says 1,000. That's the GL number that will tie in to your GL report or general ledger report. So GL 1000 is all this activity is how they come up to that number that was sitting. This one's actually their GL 1200, which would tie to 1200 on here, 441, assessments receivable. That's all this activity here. So your treasurer should be able to look at any GL on the financial and pinpoint the activity on the general ledger report. We also provide you with a check register. This is a register of all the bills we paid in the month. Now, this is only if the bill was paid. If it's sitting as accounts payable, it's not going to be on this report. This is only for bills paid. Now, with that said, if the prior month you had some payables like this association had, those will be on here because we paid them in the current month. So this is strictly a report of all payments that left your association in the current period. We wrote a check and mailed it out to them in the current period. Followed by this in your financials, I don't have it in this training because they're images, will be all your images of your paid bills that match your check register. And we'll talk a little bit about special assessments again. What is different about special assessments? If you have a special assessment, you're going to have more columns on your balance sheet. Your financial recap is going to have an additional section where we break out all the detail of your special assessment. And your budget comparison is going to have an extra, you're going to have an extra budget comparison strictly for that special assessment financial. So again, your balance sheet breaks these out: operating, reserve, special assessment. We have to segregate your funds, which is why we have so many columns on a balance sheet. Any fund that's segregated is going to have its own section on the balance sheet. And then this is what a budget comparison for a special assessment or construction rehab looks the same, but again, the information that's on it is strictly for all the funds that, all of the activity that happened for that particular fund, or as we call them, cost centers, which this one is special assessment. It's all the activity for that particular fund during that period. And that concludes the financial training. I'm going to take a look at the questions that have come in. It looks like we have quite a few, and we're going to see what answers we can come up with for you here real quick. So give me just a minute. We had one come in right at the end, so Morgan's getting that ready for us, and then we will answer some questions for you. Okay, so one question came in. It says, can we get operating statements by month, calendar year reports? We lost these when there was a switch to the new system last year. This report is essential. Yes, we hate that we lost that feature as well. While we can't include it in the financials anymore, you can certainly ask your staff accountant and we can upload a separate report. What he's talking about is a 12-month cash flow, I believe they used to call them. It's where it lists all your expenses for the whole year lined out on a financial. Yes, we can do that, but your staff accountant will have to do it as a separate uploaded report, and we're happy to do that. You just need to let your staff accountant know or let your manager know, and they will let us know that. Can we get a contact at AMS that we can speak about financials when we have specific questions? We are recording this presentation for your future use, and you can contact your staff accountant directly or your manager with your financial questions, and or we can email you a presentation later once we are able to get this all uploaded and saved and in a way that we can send out. So yes, please reach out to your manager or staff accountant directly, and they'll be happy to help you. Next question is the same thing. Looks like a couple people are asking about that. So yes, we will be getting that out as soon as we can. This is the first time that we are recording this, so it's going to take us a little bit to figure it all out, but we will definitely get that out to everybody either on the website or directly to your manager so they can get them out. Does the loan payable contain both interest and principal? Is the loan payable tracked on a budget comparison? If we don't recognize the loan principal, how is the income for that handled so the budget comparison is accurate? No, the loan payable only contains the principal balance on the balance sheet. We estimate your future interest for you on the financial recap. So if you recall, we talked about that on the financial recap, we put a special section in there specifically about your special assessment, and that's where we will break out the details of your special assessment for you. We tell you your principal, interest, and all that, and outstanding receivables. Normally, your special assessments are not a budgeted item, so owners pay off all the time, and it's just a moving target. So we're estimating often at how much we can actually collect. What should the operating fund balance be relative to the total annual budget total? That's a good question. It varies. It really varies based on if you have a lot of receivables, if you're on budget. It varies from association to association. I don't have a good answer for that, and I'm sorry for that. Do we have the ability to enter different amounts depending on the month instead of dividing the annual amount by 12? For instance, water usage larger in the summers. We do have that ability, And you just need to discuss that with your staff accountant or manager, and we're happy to make those adjustments in the budget. So just for purposes of getting budgets in and timely, we take it and divide it by 12. But if an association has a specific thing that they want to see hit a specific month, yes, we can do that. You just need to let us know. And what is the difference between community rehab funds and special assessment funds? That's a great question. They're actually synonymous. Community rehab equals a special assessment. Sometimes it depends on why the special assessment was assessed in the first place. Was it for rehab expenses? Was it to build up your reserves? Is it for an operating shortfall? It all depends. Those phrases are synonymous in our world. So it really just depends on what your association started that special assessment for, and how it's referred to. Next slide. That's all the questions. I hope you all enjoyed our training. I really appreciate you all joining us, and I hope you have a great evening. And please feel free to reach out to your staff accountant and manager with any future questions regarding your financials. Have a great evening. Thank you. Bye-bye.